but someone who is building his or her own wealth brick by brick, what role does asset allocation play in their life?
95% of your total returns from the asset class depends on how effectively you do allocate your assets. So asset allocation determines almost 95% of your portfolio returns. Mutual funds return is higher than the investor returns in that portfolio.
Correct.
Because investors typically move in and out. The model which we use is compares the GSEC yield with the Nifty TTM earnings, the trailing 12 months earnings of Nifty versus the GSEC yield, 10-year GSEC yield. We are of the opinion that this silver as a store of value is equally lucrative than what gold has been. The only margin of safety in this market is growth. So we are now very, very bottoms up in terms of what we pick, which stocks to pick, irrespective of where the sectors they represent.
How do you manage your personal asset allocation? Thank you everyone for joining in another episode of our Fund Manager series. And today we have with us Mr. Devender Singhal from Kotak Mutual Fund. He's an Executive Vice President and a Fund Manager at Kotak Mutual Fund. Been associated with them for more than 10 years. And he manages more than 8,000 crores in their multi-asset fund. Thank you Devender sir for joining us today.
Thank you, Aditya. It's 18 years now and 40,000 crores in assets, 8,000 in multi-asset.
Wonderful. So, sir, as wealth managers, we always talk about asset allocation, and it is one of my favorite topics. And we always talk about asset allocation. And for someone who has umpteen amount of wealth, someone like Rakesh Jhunjhunwala, he might not think about this topic because even if his portfolio goes down by 30%, he would not change his lifestyle. That was a statement made by him. But someone who is building his or her own wealth brick by brick, what role does asset allocation play in their life?
See, there have been various amount of studies which have been done which says that 95% of your total returns from the asset class depends on how effectively you do allocate your assets.
Correct.
So asset allocation determines almost 95% of your portfolio returns. So it is very important part of your overall portfolio and should not be ignored by any chance. Now, as you rightly said, different people may have different risk appetite and at different points in life, they could have different asset allocation. For example, if somebody doesn't need money on a day-to-day basis, for them, even 100% equity is a deliberate call to be in equity there, but that's a designed call. That's meant to be like that. But somebody who's wanting to have, a balanced approach towards all the asset classes, wants to have a better risk reward, then they may look at multiple assets in the portfolio. And whenever we talk about asset allocation, the differential assets have to be in the sense that reduces the correlation of the asset classes within the portfolio. So
Correct.
it reduces the risk to that extent. So yes, it is very, very important, irrespective of where you are, what your risk profile could be. Depending on your risk profile, asset allocation has to be there, and it is really a must for every portfolio. It could be 100% equity. Within equity, it could be VC, PE, listed equities, but that also is an asset allocation.
Correct. And it's a very personalized subject. And I also feel that someone who is very experienced can have all the money lying in aggressive asset classes. But someone who is very new and a very new investor, their investment experience determines a lot on how long they will stay in the market.
Yes.
So for someone who is a first-time investor, I believe it's the most important thing that one should look at.
Yes. So, there have been various studies which have been done which says that the mutual funds return is higher than the investor returns in that portfolio.
Correct.
Because investors typically, move in and out.
Correct.
So, and you rightly said, the longevity of your time in the fund on the investment journey would actually have a bigger impact on the portfolio than timing the part of it. So yes,
Right.
asset allocation is very important to that extent.
Right. And sir, you manage a multi-asset fund uh, of more than 8,000 crores, and you've been, and Kotak has been managing a multi-asset strategy for long. First in the FOF strategy, and now you've a normal multi-asset fund where you allocate more than 10% to at least three asset classes. Uh, and you've been successfully managing that strategy for so long. Uh, what is your mandate as a multi-asset fund manager, and how do you manage asset allocation over there?
See, as you rightly said, there are different multi-asset strategies also in the market, and we have been running a strategy for the last 21 years in the FOF
Right.
form. This particular strategy where we are managing now is basically a strategy whereby it's a similar strategy, albeit in a much more tax efficient manner.
Correct.
We are very clear in this strategy that in India, long term, equity markets give you the best return possible. So the model which we maintain basically increases equity at every available opportunity to increase equity exposure. Because we have seen that, there's a very sharp mean reversion which happens over a period of time at certain valuation points. So the model which we use is compares the GSEC yield with the Nifty TTM earnings, the trailing 12 months earnings of Nifty versus the GSEC yield, 10-year GSEC yield. And the model has basically looked at historical levels whereby it tells us when to go aggressive in equities and when to be bearish in equities or conservative in equities. The
Right.
average exposure which we have had in this portfolio is around 70% on the equity side. The max we can go up to is 100. If you look
Correct.
at this particular strategy, the average exposure would be close to 65% in equity. So to that extent, it is an aggressive strategy on the multi-asset allocation side.
So, sir, particularly looking at the current market scenario, gold is one of the favorite talking point, and we have seen a phenomenal rally in gold over the last 3 years. Uh, so, how do you look at gold as an asset class? How I look at it as a hedging asset class. When all the other asset class don't do well, gold performs. So certainly it should be a part of your portfolio, but not a major part of your portfolio. And it has periods of stagnation and then have periods of growth. But how do you, in a multi-asset fund, how do you look at gold as an asset class? And how does it impact the volatility of your portfolio?
Sure. So I totally agree with your viewpoint that gold has to be used as a hedging tool. But over the many years, it has actually turned out to be, a pretty fantastic tool, specifically for the Indian markets, because you've seen the depreciation also of the rupee adding to the gold returns, and then to some extent the taxes which have been there that also added to it. But nevertheless, even globally, gold has been a pretty decent asset class in terms of the performance. Having said that, it has not been able to beat equity returns over a longer period of time, and the current rally which has happened, I think it has more to do with the global volatility and the fluctuations in the overseas relations between many countries, whereby as a tool to hedge themselves from an overexposure into a particular country, specifically USD, many of the sovereigns also started buying. India,
Correct.
China have always been buying gold, but the sovereigns buying gold to hedge against the US dollar has also added to the gold's lucrativeness in the recent past to add to the overall returns in this portfolio. So yes, as long as you see these things not settling down, gold would find favor both with the investors, the wearer, the actual user, and with the sovereigns therein, which all adds to its popularity there. Having said that, can we expect similar movements of gold which have happened over the last 3 years? I would actually be very, very, um hesitant to say that, that could actually get repeated. But ride it as long as we are seeing it. One needs to be a bit cautious there, and as to how, because we've seen a very swift rally in the gold in the last few years. It may not continue as smoothly as it has been so far.
Right. And now, sir, moving on from gold to silver. So silver has been a more volatile asset class than gold, and historically, gold price has been 60 to 65 times the price of silver,
Yeah.
wherein currently it is at 85 times. So, with respect to gold, silver looks more attractive. So, how do you look at silver as an asset class? And we have seen that you have you maintained a overweight position for long in silver, and that has also uh, dis- worked well for you. So, how did you think about silver at that moment, and how are you looking at silver now?
See, you're right. Specifically post 1970s, when the gold standard was being taken off, silver has historically been there around 60, 65 to 70, 60 to 70 grams of silver used to get you 1 gram of gold.
Correct.
In the recent past, it went and touched a high of 105 grams for 1 gram of gold versus 105 grams of silver. Now, we are of the opinion that this silver, as in store of value, is equally lucrative than what gold has been. So we were expecting a mean reversion to this trade therein, which is where we added silver to the portfolio. Luckily, it has worked us in our favor, but there are quite a few of other things which have also helped silver perform as much as it has in the recent past than what gold has done. Quite a few of them have been, for example, over the last 4 years, silver, there's no new mining which has been set up for silver. In fact, few of the large ones have actually got closed. So there's no new capacity which has been created. Second is the increased usage of silver in batteries, in solar panels, and now with AI, more and more high speed cables are wanting to convert to silver to do that. You'll be surprised to know that EVs also use a lot of silver. The more autonomous you get, the better the use of silver gets into the vehicle therein, which is propelling the use of silver to a large extent. We were doing some analysis today. 2 million ounces of silver gets delivered, gets getting produced every day, and similar is the amount of delivery which has been taken at the stock exchanges globally. With advent of silver, silver ETFs, it is increasingly becoming easier for the investors also to hold silver.
Correct.
On top of it, two sovereigns have started buying silver as a reserve. First, it was Russia, and recently we saw a Middle East nation also started buying silver. So yes, we do expect silver to continue its journey for some more time. But yes, I mean, so far we've been lucky. I hope we continue to be on the better side of this trade for some more time.
Right. And we also we have been actively allocating in your fund because you've been maintaining that amount of you've maintained good amount of silver in your portfolio. So we were quite positive on it, and we also gave a call on silver ETF uh, around in May, and appeared to be a very lucrative, good bet to take at that point. Uh, Particularly, as you rightly said, it's widely used in industries, and one of the points that I was hearing when I was talking about it was that it's very difficult to store. But now with ETFs, you can easily invest into silver and hold it in your portfolio. Now, sir, coming from commodities to equity, since major part of your portfolio is um, comprised of equity, uh, and we have seen a phenomenal rally from 2023, March 2023 till September last year. And since then, there have been global uncertainties, and our earnings also slowed down. Uh, and since then, market has been volatile, still down from its all-time high in September last year, but it has been volatile. So, which are the key sectors uh, where you are, or which are the key themes, not just sectors, where you are overweight uh, as a fund manager or as an AMC, and which are the key themes which you are underweight?
Okay, Aditya, first of all, you rightly said that, that over the last 1 year, especially post September last year, there's been a slowdown in the earnings and it has also reflected in how the market has behaved. And this is precisely the reason that we don't want to be, sector specific at this point in time. The only margin of safety in this market is growth. So we are now very, very bottoms up in terms of what we pick, which stocks to pick, irrespective of where the sectors they represent. So it is not more of a sectoral call, but a purely bottoms up strategy in terms of which stocks can offer you better growth for the valuation they are being trading at. It has just so happened that quite a few of our names in the portfolio are part of the automobile segment, consumer discretionary, consumption, power, and likewise. So, but and honestly, these are also the segment where the market is now more hopeful, specifically the GST coming and the GST rate rationalization, which will also give a fillip to this overall consumption. These one be the sectors which will also be a bigger beneficiary of these themes. So, yes, again, luck has played its part. We were exposed to these sectors, and now you're seeing a bigger push from the government to get these sectors, a into a zone whereby the earnings could basically accelerate going forward. So yes, these are the ones there. And if you look at it, what has happened over the last 6 odd months? First, you saw the rate cuts happening, income tax cuts happening. Second, you saw good news on monsoon happening. After 5 years of good monsoon, nobody was expecting a good monsoon coming in. We're getting a pretty good monsoon again. The rural wage inflation is now more than the rural consumer inflation. So this is also added up. We saw a repo rate cut of almost 100 basis point we've seen, which would be impacting the EMIs on the lower side, right? So almost 1.2 lakh crore is getting saved due to this EMI reduction, the rate reduction. 1 lakh crore is from the income tax reduction, and then various estimates are putting that almost 1.8 lakh crores is coming from this GST rate rationalization to the end consumer. So all this is going to push the sector growth going forward. So yes, where we are, where the growth is likely to be. So hopefully things should turn out better.
Right, and so as you said about growth, and when someone asks me about um, what are the return expectations, so I do not give them return expectations. I talk about earnings growth, and particularly I'm a strong believer that market returns would follow earnings growth that we would see in the market. And when I tell my investors to invest in equity market, I expect Indian listed companies to have an earnings growth of double digit. So particularly with respect to how uh, India is currently commanding a premium with respect to valuations, what kind of earnings growth rate estimates you see over the next 5 years? I would not say for very long 10 years, but over a period of 5 years.
Actually, I give you 10 years, 10 to 12 years number.
Okay.
I tell you why. See, India today is at the cusp of a new growth story. I'm not saying that we can go back to the high days of 8-9%, but I think it would be difficult for India to grow below 6%. In our view, with the way the current government is functioning, the way the current market is poised, I think a 6.5-7% on the real GDP side is definitely doable over the next 10 years, 10, 12 years. With some bit of push, some bit of reforms, ease of doing business, these growth rates could actually be higher than what we have achieved. And we saw what happened with the Q1 number, GDP number, which came out, right? Now, if we assume 7% on the real GDP side for the next 10, 12 years, I think a 4% CPI inflation is pretty a reasonable number for us to expect.
Correct.
That takes it to around 11% on the nominal GDP side. As you rightly said, corporates typically tend to do slightly better than the nominal GDP. So if you add a percentage point to that, 12% on the real, corporate earnings is what we can grow. And market valuation would follow the earnings. So you can do the maths. That's the number which is there in front of you. So at 12 years, if it go by 12%, your earnings quadruple over the next 12 years. I think that's a very, very good number to look at going forward.
Makes sense. So that's also something that I also look at in terms of nominal GDP growth and expecting the corporates to uh, do slightly better than the nominal GDP growth rate. Uh, Thank you so much, sir, for such lovely insights. My last question is, since we are doing this session on asset allocation, how do you manage your personal asset allocation?
See, apart from my mandatory reductions in the PF and whatever happens on the EPF side, I am not a person who keeps a lot of money on the debt side.
Okay.
I would have around 6 months of my savings, my expenses being parked into a checking account, and rest works for me in the market day and night. That's how it is.
Lovely, lovely. Thank you so much, sir, for such wonderful insights, and uh, we look forward to doing more such sessions with you and your fund house. Thank you.
Thank you, Aditya. Thanks for this opportunity.